Move from a $1.7 billion market cap, guys, to one of $270 billion. That's AT&T's market value right now. And I did want to address these reports in the Wall Street Journal this morning about a potential examination by the company of splitting off the DirecTV unit. We've talked endlessly about the weakness of DirecTV, the loss of subscribers quarter after quarter, the lack of sustainability of the DirecTV Now product. But I do want to add here that after speaking to any number of people familiar with the situation, close to AT&T's thinking, they are not focused on any sort of split right now of DirecTV from the overall business. You know, I've always, as you know, Jim, had an issue with these considering kinds of stories. Companies consider everything, particularly when they're in an activist fight. You have to consider everything. It doesn't mean that you're going to do it. And in this case, again, it does not appear that AT&T is at all really focused on the possibility of splitting off in some fashion DirecTV. Now, there has also been a lot of speculation. Well, is it possible you could do a reverse Morris Trust, roll it into Dish, of course, run by Charlie Ergen, create that combination and conceivably create value? You know, Ergen was at the Goldman Sachs conference that I attended a couple of days ago. I listened to his presentation there. I spoke to him along with a couple of other reporters afterwards. It did not sound like he's particularly focused right now on that as a possibility. He always plays his cards close to his vest, often says how he's a poker player. But the fact is that he's got an awful lot on his plate. Regulatory-wise, it's still not clear that it's something that could happen. But more to the point, Dish is really focused on, A, seeing whether Sprint can get this deal through the states right now where it's going to go to court, and B, creating a national 5G wireless carrier. So, Jim, you know, DirecTV has had a very difficult time. There's no doubt about it. It's not worth anywhere near what they paid for it back in 2014, but it still does generate $4 billion in free cash flow. We said at the time it was bought in part to help sustain the dividend. Right. That certainly still helps. It's unclear what kind of multiple they could get outside. It's a deteriorating business, and so AT&T is simply not focused on this as a possibility, despite what the Journal reported this morning.
Is there any chance that Elliott, the activist here, thinks that it's just poorly run, and it could be run better? And it certainly would be run better, and then it could be disposed of. I have it. I don't understand why it does so poorly. I'm not kidding.
Well, it doesn't have a broadband product, per se. Right. The NFL is one of the key offerings that it has, and people are cutting the cord. I mean, it's just as simple as that.
So, in other words, people are not wanting to watch the out-of-the-market games, which is why I have it.
Listen, you do, and many others do for that reason. But it's not enough to sustain it, right? It's still got 22 million subscribers, still doing $4 billion in free cash flow, but it's nowhere near what it was when Mike White sold the business to Randall Stephenson.
So we got had. Sometimes you just get had.
And there's no doubt that Elliott, as it pointed out in its very long letter, is disappointed to some extent with a lot of the performance of the businesses that AT&T has purchased over the last few years, wondering about the full strategy, questioning, of course, John Stankey's elevation potentially at some point to CEO, but even to COO when he does appoint somebody else to run the Warner businesses. This is going to take a little time. Although we do have a self-imposed deadline of the end of January when the nominating window for directors closes.
You know, I'm thinking, David, I'm going to be interviewing Bob Iger. He has a new book out.
You are
Ride of a Lifetime.
Interviewing Bob Iger?
Yeah, I got that from you. You were going to, but I front-ran you.
So you're sharing that news with me now?
Yes. And what I think is interesting
is
great
to hear. Congratulations on that.
Thank you. It's a big get for me.
Yeah, I bet it is.
Recognizing that.
Yeah.
And one of the things he talks about is the fabled, which I know you covered, Philadelphia shareholder meeting, where you basically got the end of Eisner. Is there a moment where this could come to fruition, where we see the end of the Stephenson regime just because of pressure? I don't think people are that happy with it.
No, they're not. They're not that happy. Now, listen, their advisors will tell you, of course, hey, the stock price has done very well this year.
30%.
But take it into consideration, of course, what it did last year and the year prior. It has been a decent year for AT&T shares. They do say, what I find interesting in all of this is everybody wants to come back to the performance of the wireless business, which is doing pretty well, and is doing well, as you said a few weeks ago, and I disputed it on surveys in terms of actual service surveys. But you know what's funny is he's been running away from this wireless business for the last 7 years, and now suddenly they're all like, well, it's still 50% EBITDA. It's still doing really well. I do think that is somewhat ironic that AT&T has chosen to hang its hat on the performance of its wireless business, which it was diversifying away from.
After all of this trying to get away from it, and you know, David, we never talk about Verizon trying to get away, but they bought Yahoo.
and AOL. But those were minor bets.
No, but they had this thing called Oath.
Yeah, Oath.
And they were willing to take the hit there. I know it's much smaller DirecTV, but
they did the write-downs.
They did the write-downs.
Yeah.
Were it painful?
No, not particularly.
Really?
Not in the size of them.